Hey guys, welcome back to the After Hours. I'm the 8-Tailed Beast, and today we're going to talk about bank stocks. One bank stock in particular, that's Credit Suisse. Let's get into it. Now, when it comes to these bank stocks, we are technically on the edge of a crisis. We're at the cliff, and it's almost time to fall down. The main thing is you want to know, where do you stand? Where does everyone stand? And can you do anything about it? Well, first, we're going to have to talk about history. Why is Credit Suisse so important? Think about it. Credit Suisse, it is the second largest bank inside of Switzerland. And when it comes to bank stocks, you have to understand they all have to follow rules. It's all a part of a fixed system that can only be changed by the back end from the Congress and other central banks. At the end of the day, everyone has to follow these rules, even the people that set the rules. But when there is something in the background that reaches the surface, that's usually just the tip of the iceberg. And what we've been seeing lately is a lot of that iceberg has come up. We've seen systemic risks inside of the US regional banks. We've seen a contagion of fear going through the debt markets. And at the root of it all, it comes down to the faith in the banking system. If you ask the people that set the banking system, they'll swear up and down that everything's okay. But the actions are speaking louder than the words. When you look at Credit Suisse, which was a bank stock that came up in October of 2022, everyone expected it to be the next Lehman moment. Yeah, that bad. At the end of the day, Credit Suisse was saved by oil money, specifically Saudi National. Now, Saudi National, we know that that's oil money. That's a lot of money. That's a big backer. Well, after they lost $1 billion, they canceled any further financial assistance. And as a backup, Credit Suisse had to cover the withdrawals for their customers. And up to this point, they already lost all credibility in their last investment in Arch Egos. So their credit rating was in the toilet. No one wanted to deal with them, even the central bank. Up to this point, Credit Suisse has been in the business for 170 years. That comes with a lot of pros and cons. When you survive 170 years, or even something even close or half of that, you have something that others don't. So when it's time for you to knock on heaven's door, you can put up a struggle. When Credit Suisse went to the central bank and asked for a $54 billion bailout deal, they were denied. But that's just because the central bank had a plan B. Plan B was to go to the rival Swiss bank, UBS, and they cut a deal for a $100 billion credit line, which they were only able to do after they had a joint liquidity operation where they gathered the central banks together. They shook hands and said, "You scratch my back, I scratch yours later." They accepted the deal, but it wasn't like they had a choice. Several rules were bent in this whole situation. A rushed merger happened. At the end of the day, they gathered up to $5 trillion. After they gathered this money, they said, "We're gonna cut them a deal." So this problem stays inside of Switzerland. It stays inside of Europe and doesn't spread to a global market, because that's the cliff we're on top of. There was a contagion under all of this, and it was a fire. And this contagion was spreading through the debt markets, and it was threatening to go to the stock market. Or for now, what's important is the central banks have to stop this spread of fear. The major pieces of this puzzle is Credit Suisse. And that's because it's an old, well-known, and big bank. If a big bank goes down, the whole faith in the banking system goes down with it, especially after the fire started inside of the US regional system, where one bank already failed, and it was a bank that was also too big to fail. So the contagion is already on a global scale. It actually started in America with SVB. And if you want to know more about that, you can go to this video. But if you want to know what happened in Credit Suisse, you'd go to this video. We had two contagions going on at the same time, one in Credit Suisse and the one in the US regional banking system, which can lead to its own domino effect. Now, if both of these happen at the same time, this was bound to go to a global scale. And at that point, all we can do is watch it burn. Now back to Credit Suisse. Credit Suisse, it's old. It can put up a struggle, but it entered the same theme that's been seen in bankruptcy themes. These banks recently have been acting like meme stocks. They have gone from hundreds of dollars down to almost single digits. Their volatility, it's insane. Now Credit Suisse, they technically started that back in October. They revealed all kinds of bad management strategies, even that the CEO's last name is Lehman. But it wasn't all bad. The people that bit the bullet in this situation inside of Credit Suisse wasn't just the bondholders, because they definitely bit the bullet. There's a reason that contagion spread so fast inside of Europe after they lost $17 billion inside of bonds. And it was actually planned all along. There's something called a Tier 1 bond. A Tier 1 bond has a special fine print. If the bank ever goes below a certain threshold, the debt will be wiped clean, and the capital from that can be used as a financial cushion to revitalize the bank during the event of a financial crisis. And we are on the verge of a financial crisis.
SVB started an avalanche. It started a chain of failure after it exposed the systemic risk. The next one in line to fail was Signature Bank. There were more banks at risk, but the FDIC was quick to move and stop from a technical failure of the bank. Signature Bank was dissected by the FDIC. $60 billion in loans were going into receivership from its major investments in crypto. The remains went to the rival bank inside of New York. It went to NYCB, which is New York Community Bank. And I'm pretty sure they got it for cheap. Now with NYCB, they did not take any of the commercial property inside of the deal, which is weird because that's their main thing when it came to Signature Bank. But moving on, Silvergate was another bank that was threatened. All these banks had high-risk investments, so the FDIC made sure to put on some regulation. And the regulations were too much for Silvergate to stay in business. So they shut down and had to liquidate themselves. Now the one that is in everyone's eyes outside of Credit Suisse is First Republic Bank. Everyone's discussing FRC being next in line to fail because it received tens of billions of dollars in rescue packages that came from larger banks, but it still didn't keep it from plunging 60% on the first day and 50% after the packages. And the thing that really put the nail in the coffin is the same thing that happened to Credit Suisse. It was the downgrade of its credit ratings. Credit Suisse had 170 years to build their reputation. First Republic Bank, not so much. So FRC is now testing the water for all US regional banks. How is this systemic risk going to hold up inside of this market condition? The Fed and the FDIC is in a tough spot. They have broken rules up to this point, and they don't want to start another round of QE. They did add money to the balance sheet last week, but they want to keep things under wrap. So what they did was they did a stealth QE. This is pretty much a private QE. They asked other people with the money to spare, could you front us this and we pay you back later? At that point, the fear was entrenched inside of everyone. They needed to get their money out, and it caused bank runs. Now, the possibility of someone stepping in is very high. In these discussions, in the effort to save the faith in the banking system, Warren Buffett's name was mentioned as one of the people that could potentially be a donor. There's a higher chance that he's just going to say, it's a fire sale, you should buy something. But another organization came out to save the day instead, which is normally a next to last minute lender for banks. And they issued $300 billion in a week. This is nearly double the $157 billion that the Fed offered to the regional banks. It wasn't soon after that US stocks rallied right before the FOMC meeting on discussions of potential rumors that they were studying how to insure all depositors. But we know that's kind of illegal. But anything's fair game at this point. They just don't want to start another round of QE or cut hikes. Now the FOMC meeting, it happened, and it looks like we're on our own. There won't be any cuts. We may have a hike or a few more. There were no clear answers. We're pretty much on our own for now. But all right, that's all I got for you guys. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.